After a gigantic miss in the labor markets, do the charts have a concerning look? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index. We're showing market model recommendations. This is the recommendation for the allocation to stocks. So right here the model is saying you should be in roughly 92% stocks or risk assets and roughly 8% conservative assets, which could be a currency, a bond, cash, etc. Why do we do what we do? We manage risk. That's what we care about first. If you worry about managing risk, the rest of it will take care of itself. This is the October 9 low of 2013 in the S&P 500 index. The model scales away when bad things are happening and recommended an allocation of 41%. And then when the observable evidence begins to change, it quickly scales back in, allowing us to capture these gains in the S&P 500. The average allocation between point A, here, the bottom on October 9th, and here, the close on January 10th, was 89%. You could say you missed 11% of upside with only an 89% exposure. That's where risk-adjusted returns come in. Yes, we did, but we also managed risk, and we can sleep better at night. Why do we do this, this, and this when we see weakness? We manage risk and reduce exposure to stocks when we see observable weakness because, as Friday's employment report made abundantly clear, no one can accurately predict the future. Heading into Friday's report, the average forecast on the street, the consensus was for a gain of 200,000 jobs. The average forecast was only off the mark by 270%. The forecast was for 200,000 jobs. The actual number was for 74,000 jobs. The CCM market model looks at observable evidence and forces us to stay in the now, here. Don't want to regret past mistakes or worry about the future. This is the only thing that we can control. Since we can't predict the future with any consistency, the market model steps away from risk here, here, and here because we don't want to rely on those experts that miss Friday's payroll number by 270% to forecast and tell us how to manage our money here. This is a daily chart of the S&P 500. The model steps away because we never know when a look like this will morph into a look like this. Moving back to the allocation adjustment since the October 9 low in 2013-2014, a fair criticism may be trading costs in here. First of all, the model only allocates to hard rules on a Friday, doesn't do it every day. We do make midweek adjustments based upon some midweek rules. But let's talk about trading costs for a minute and put them in perspective. If you'd like to read this entire paragraph, you can pause the video in the lower left-hand corner of your video player. Purpose. Let's assume I had $1 million portfolio invested in the S&P 500 index in October of 2007. And my primary objective was to minimize taxes and trading costs. If that was my primary objective and I was a buy and hold investor, my $1 million portfolio from October of 2007 would have lost 58% before the stock market bottomed in March of 2009. If I lose 58% on $1 million, that's $580,000. We will never, ever make $580,000 worth of trades. How many trades could I pay for with $580,000 of lost principal? The answer is 64,000 trades if my transaction costs are $8.95 a trade. Trading costs and taxes, absolutely positively important, but principle is what matters most. Regular viewers know that we've used this chart and these concepts effectively to discern between weak periods in the stock market in 2011 and 2012 relative to what took place in 2013 and in the present day in 2014. We'll explain the concepts on this chart in detail, and then we'll quickly scroll through numerous charts that use the same concepts. This looks noisy and complex. It's easy to understand. This is the S&P 500 up here for reference purposes only. The meat of the chart is the ratio of bonds relative to stocks. So in this case, we're looking at risk off versus risk on. When investors are concerned, the demand for bonds begins to rise relative to the demand for stocks. The stock market tends to be weak when people are concerned and they'd prefer to own bonds. People are concerned here. The demand for bonds is increasing relative to the demand for stocks. Stocks are weak. I'd prefer to be in bonds is the look here. Stock market weak. I'd prefer to be in bonds here. Stock market weak. Moral of the story is, prior to a big correction in 2011 and these corrections in 2012, this ratio waved some yellow flags that could have helped us. You can see the demand for bonds is rising here in 2011, so we want to focus on the slope. This tells us that concerns are increasing. The stock market went sideways. This is a divergence here. This is rising. This is going sideways. Yellow flags. Stock market went down. 2012, the slope. We're making a higher low relative to this low and a higher high in this ratio, telling us that demand for bonds was increasing. I have a positive slope here, waving yellow flags telling me to be concerned. Stocks drop. Positive slope here, waving yellow flags. Positive slope, waving yellow flags for the stock market. Let's compare the present day and the read on this chart for the demand for bonds relative to the demand for stocks as of the close on Friday, January 10th, 2014. My present day slope here, which I can move this line here and move it here and move it here. If I compare the present day, 2014 to 2011, they don't look similar at all. So we're not getting yellow flags in 2014 that we were getting in 2011 before this correction. We really don't look anything like this period in 2012 before stocks dropped either. The demand for bonds is dropping in 2014 relative to the demand for growth-oriented stocks. Same story here prior to this correction. Moral of the story is this chart has a risk-on look for stocks. We need to see observable evidence. We need this look, which is price, or the ratio below both moving averages, blue below red, and the slopes down. This is a full-bore, bearish look on a weekly time frame for bonds relative to stocks. Our concerns increase when we move to a full-bore bullish look for bonds as we did at this point. Notice here, this is the mirror image of what we have today. The ratio, price is above both moving averages, blue is above red, and the slopes are up. This happens before, it's observable before the stock market tanks in 2011. We'll pick up the pace now. You can use your pause button if you want to look at this in more detail. Same exact concepts. We've got hedging or risk off relative to the S&P 500. Same concepts apply. This is a yellow flag, stock market weak. This is a yellow flag, stock market weak. HDGE, think of it as a short. This is shorts divided by longs for the most part. These are yellow flags before the stock market drops. The present day looks nothing like point A or point B. One of the strengths of the CCM market model is that it intuitively makes sense. We didn't curve fit, we didn't take data and build a model that produced results based upon the data. We used economic and common sense logic to build a model, and then we back tested it. Same concepts, consumer staples. If I'm running a mutual fund, I have to stay fully invested. In 99% of the cases, I can't move to bonds in some cases or cash. So when I'm concerned, as I was here in 2007 and 2008, I can try to minimize the damage by moving into conservative or defensive consumer staples. Demand for staples rising, stock market does poorly. Demand for staples rising relative to the stock market, stocks don't do well. The present day looks nothing like this or this and aligns with the bigger picture in the readings on the CCM market model. The previous charts were all risk off divided by risk on. We'll transition now to just a straight look at SPY, or the S&P 500 ETF that we own, and then we'll move to risk on divided by risk off and look at several examples. The concepts are the same. This is a full bore bullish look, full bore bearish look. The present day is maintaining a full bore bullish look, and we made a new closing high for SPY this week. Our momentum is still strong. Good things tend to happen when momentum is strong. Our concerns pick up when momentum gets weak. This is a chart we showed several weeks ago as bullish evidence. This is a W formation. Now we're looking at risk on, the S&P 500 index, relative to risk off, or the fear index, the VIX. S&P 500 here for reference purposes only. This chart has a bullish look for stocks and the economy. The ratio is rising, telling us that the demand for stocks relative to the VIX is increasing. Momentum down here looks good. It's improving on a monthly chart. Same concepts as the last chart. We're looking at risk on small cap growth, IWO, relative to the S&P 500. When the ratio is rising, IWO, or small cap growth stocks, are in greater demand than the S&P 500. You can imagine that that has a bullish slant to it. If I'm nervous about the economy, I'm not going to want to invest in small and riskier growth-oriented companies. I'd prefer to be in large caps. We have a base here that built for over 2 years, a bullish breakout, and we've held it, and this ratio is still maintaining a bullish look with renewed bullish momentum early in 2014. Do these common sense and intuitive concepts help? Well, you'll remember that we've shown this chart as bullish evidence in the past, which is a recurring theme, and the stock market continues to go up. So far, so good. Now we've got high beta stocks, cyclicals basically, relative to the S&P 500, risk on divided by risk off. We still have a bullish look on the weekly chart, and this long-term breakout here is holding. All of this leans towards the risk-on case. If the master market model tells us that we should be in 93% stocks and 7% bonds or cash, how do we determine what goes into the 93% on the equity side? We have an ETF scoring model that we've never really shown the mechanics of or the math behind. There's a lot to it, but the basic premise is you're looking for things that are outperforming the S&P 500. So this is the SCHB. It's a lot like VTI. It's a broad market ETF, broader than the S&P 500. We'd prefer to be in things that are trending on a weekly basis. SCHB, which we own in many accounts, is trending and has a bullish look. We own financials. Why do we own financials? They're outperforming the S&P 500 index. We can hold them as long as this bullish look remains in place. You can see this is the early stages of a bullish move. Often when you get something like that, you get outperformance for a long period of time. If we morph into something like this, mathematically we'll be forced, we'll have no choice by the rules to scale out of this. Why would you want to do that? Well, XLF underperforms here for several months. We would like to avoid that, all things being equal. Has it been all fun and games off of the October low? The answer is no. You know going in that you'll have some positions that don't work out. Emerging markets is one of them. This is emerging markets relative to the S&P 500. It appeared as if emerging markets had the bullish look here. We bought and owned emerging markets. The model has forced us to scale out. We're all the way out of emerging markets. When would we consider emerging markets? It has to get back to this stage here. After this bullish look, it outperformed for several months. Could emerging markets morph into something like this or this and do well? Sure it could. But right now we're not allowed to own it. This is what's known as a whipsaw. This is a bullish signal because intra-week even, blue was clearly above red. Intra-week we had a full-bore bullish look here, and this is an improving look that's checking boxes. A whipsaw is a known issue with a probabilistic model. Sometimes you get a buy signal and it doesn't work out. That's fine. You just have to have a way to scale away and get out of a position quickly that's not working. This is an example of that. We don't own EEM anymore. We're open to owning it again if it improves. No one knows when the next bear market will start. We have to be able to handle two cases. This is case B, where the stock market drops roughly 50%. Here's what happens to your principal if you lose 55% over a 2-year period. We also have to be able to handle case A, where stocks surprise on the upside and rise for another 3 years as they did from this point here in 1997. Valuations are already stretched here. We already have talk of a bubble. Sound familiar? And the stock market gained 91% from point A to point B. Here's what happens with principal with a 91% gain. How do we handle all this? The CCM market model. Risk-adjusted returns also have a sleep-at-night quotient to them. The market model was designed so we know that we can handle case A or case B, and we can sleep better knowing that we have a system in place for both bullish and bearish outcomes, and even extreme bullish and bearish outcomes. How do we determine the allocations? We track, we answer binary and unbiased questions, or we look at hard data. We get a handle on the current market profile. We compare it to historical profiles and then recommend a prudent allocation. If you want to explore in more detail how the market model might be able to help you answer those questions, you can visit our website or follow us on Twitter, Facebook, our blog Short Takes, or our weekly videos on the Shavako Capital Management channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.